So guys, we're going to look at an example of why it is so important to take into account all imbalance when trading these efficient markets like the euro dollar. And we can see that we've had this massive impulse here. Now, although the momentum was massively bearish already, even if the bearish momentum was reversed and the market was actually trending upwards long term, we get a breakdown of structure like this, guys. We're going to be looking at a short setup simply because the momentum has changed. We draw some structure out, guys. We can see that we've had a break of this swing point by here. We had breaks to the downside, breaks to the upside. This would have been a swing low. We wouldn't count this as a break, guys. Not only did it happen during spread hours, but it's also only one candle. We then get a break through this. We're going to wait for some structure breaks to the upside to confirm that, like so. We can see a minor structure point by here that was broken. And it's minor structure, guys, simply because it happens between a major high and a major low. This is a major low. This is a major high. We've then had minor structure breaks to the upsides. That's happened within this major range. We can then confirm our swing. This for now is a minor swing low, guys, until we get a break of major structure, which will be this high by here. This remains as a minor swing. Once the major structure breaks, then it's confirmed as a major swing. Once we've got the minor swing or major swing marked out, we can follow the market back. We know this is the major swing high. I'm just going to mark that. And then we're going to look for imbalance, guys, and also liquidity. Now, like I said in the last video, this is not about the setup. This is more for you just to see the market reacting to to imbalance. So, as many of you may know, this is the order block that many smart money and supply and demands mentors would be teaching to trade from. It's the last counter trend candle before the impulsive movement. We call this, in my community, a standard order block. We can actually see now that we've got our imbalance indicator on that these candles are also imbalanced. If we zoom in, we can see that the lower wick of this red candle by here didn't touch the upper wick of this red candle, meaning this is an imbalanced movement. The market has come back up to mitigate it, but it hasn't mitigated completely. We can actually see by here that there is a large amount, well, I say large, a very small amount of imbalance left, but imbalanced nonetheless, and it implies that the order block here, which had unfulfilled orders, still likely has unfulfilled orders. All of those orders couldn't be filled completely, causing the imbalance in price, and the market will be manipulated back to this zone through engineered price action, guys. The source of imbalance is like a magnet, so it will draw the market back. You'll also get market makers in manipulating price action like this, causing liquidity on both sides of the market, and they will use the liquidity to spike the market up before moving the market back on its original path and order flow. Now, we did actually get involved in this setup, guys, and I will post an example of this setup in the material section in the my account section on the Vega website, just so you can access that. And we won't cover it in this lesson, but there is localized liquidity, which needs to be accounted for in our stop loss and entry. So if we were going to be looking to trade from this zone, we'd be looking to give a more generous stop loss. But for now, I just want you to see the market reacting to this zone, guys. Got liquidity built up by here. You could have drawn it like that. Liquidity built up by here. And the market then breaks down.